So 27 will be the last one.
27 will be the last.
Okay.
After that, of course, if you people need any help on anything, if you want any clarity, you can always call me on a one-to-one basis. That is not a problem. But as far as this course is concerned, that we will finish on the 27th.
Okay.
So where are these other people today? Shruti was supposed to
come. Shruti has given but she's in traffic.
Who?
Shruti is in stuck in the traffic, so she will join soon.
So Shruti will join soon. And what about Tanya?
No, nobody has given the message.
Let me just put a message on the group. Paresh ji is also not here. Yesterday also he was not here.
Yesterday was also not. Last week also they missed that one. I think some meeting is there.
Last week he missed one class. And yesterday also he missed something. And since we are coming to the end of the course now, so the last 2 weeks are only there. In fact, apart from today, we only have
next week.
Like we can have a class. After that, we have to devote the time to the test. So it's necessary that everybody attends this. Even Alice is not here.
Alice, Tanya, Shruti and Paresh ji. I think just wait for them. I think.
Whatever we had discussed, Praveen ji, about this, is there anything you would like to ask with regard to that? I'll just display the slides so that you can at least see. Now, there is one point which I was making that day, yesterday, which I just want to emphasize again. So, just this particular thing, this Tanya at least is here. Okay, good evening, Tanya.
Good evening, sir.
So I thought you will not come today.
No, sir. Actually, still I'm busy with my college project, sir. But sir, I've managed this time.
Good. I think Shruti will join us soon, and sir, I hope Alice also.
Sir, actually, she has messaged. She's in traffic. That's why she is unable to join.
Okay, so I think she'll come in a little while. She should be able to.
She will come.
Okay. So today's main topic, of course, will be banking. The last few days, because we have covered everything else. But which I wanted to just discuss with you people before I close this unit on financial accounts was, did you understand this DuPont analysis? What is the difference in this? See, in this DuPont analysis, I had tried to show you that return on equity in DuPont is basically, it is done by, see, normally, suppose Praveen ji, I ask you to calculate the return on equity. What will you do? How will you calculate this? What are the two things which you will consider? What divided by what? Tanya, Praveen ji?
Net income upon sales.
No, equity.
Okay.
See, if it is return on equity, the return is net income. That is okay.
Okay.
And the denominator will be equity. So equity is basically the net worth, which is the two things which are there. So the easy way to calculate, let's say, return on equity will be, I simply take the net income and I divide that by the shareholders' funds or the net worth. That is the simple way. But what DuPont explains to us is that the return on equity that we are getting, that return part, equity of course is fixed. Whatever you invested in the business, that is your investment. But the return is actually, it is based on three things. This is what I want to emphasize. One is the margin, net income by sales. For example, if every, what is the profit that I make? The profit after tax, what is the profit that I make for every 100 rupees of sales that I make? So obviously, the more profit, the more my margin is, the more will be the total profit. This is one thing. Is this clear? Praveen ji, Tanya?
Yes, sir.
This is number one. The second thing is, how much sales do I have? Considering the total assets, what is the volume of sales? So if I want to find out my, the total asset turnover ratio, then what I do is I take sales and I divide by total assets. So that gives me the turnover ratio. And finally, if I take the multiplier, what is the total assets by average net worth? That is my multiplier. That means the multiplier, remember, is apart from the equity that you have borrowed some funds. Along with the equity, you have used the debt to create some total assets. So how much have you borrowed? The more you borrow, the more assets you will create. And if you are able to earn more than your rate of interest on the borrowing, you will naturally create wealth. You will have a good return. So what DuPont explains to us is that every firm, it has to basically ensure that at least one of these two things is good. Either it has a very good margin, that means net income to the sales is very good, or it has a very good sales figure itself, the turnover is huge, or it has managed to take a lot of debt and it has used that to create a lot of assets. So basically, that it says that everything ultimately depends on these three things. See, in the red, I have written margin gain. So in a way, manner of speaking, there are three games which the firm can play. Whatever business they are doing, they can either play the margin game, which means that the margin will be very high. The volume need not be very high. The leverage need not be very high. But since the margin is very high, they will manage to earn a lot of return. So the return on equity will be very high. Now, where will this happen? In the luxury goods segment. So we all know that luxury goods are priced at huge levels. So if you buy a watch, a wristwatch, let's say made by Rolex or Omega, so you will find that the cost of the watch is huge. It is not related to the cost of production. So you are paying a huge amount in lakhs for just a wristwatch, which can be easily bought for maybe 2,000 rupees or 3,000 rupees. But you are willing to pay that huge amount because you need to have the right to say that I wear a Rolex watch or I wear a Omega. So, or you take this example which I had given here of luxury car makers. So if I have a BMW or I have a Skoda, what will happen is that I am willing to pay more to possess this thing. So these companies who deal in luxury goods, they are basically focusing on this, the margin game, have great margins. Then there are a different lot of companies who are basically catering to a bigger market. People with, let's say, less income, but who have a need for that particular product which they are making. So let's say that in the car segment, it would be something like the Maruti Desire, for example, or the Maruti Baleno. In these cases, the margin to the company is less. See, there is so much of competition in the segment. For example, if you just take the Maruti Desire, the Swift Desire, almost every company has a similar car. So for example, Hyundai has Accent, Tata has Zest, Honda has Amaze, Ford has, I think it's called Aspire. So each and every major car manufacturer has the equivalent of the Swift Desire. Basically, the features of all these cars are exactly the same. The length is the same because the basis for taxation of cars is the length of the vehicle and the power of the engine. That is the same. Inside the car, some minor modifications may be there. The engine is slightly different in each of the cars. But basically, all are good cars. As a driver, you would feel almost that the cars are equally good. Now, these people, if they want to make a good return, they have to rely more on the number of vehicles that they sell. So they play the volume game. But then we come to the third. There are some industries, like for example, banking. Today we'll see this. Banking cannot actually go for huge margins. The margin is small. It cannot go for volumes because they have to make sure that the quality of the loans that they give is good. If they go for volumes and make a large number of loans and the quality is bad, then the bank will end up with a large amount of bad loans, which will ultimately result in the bank collapsing. So they can't do that. So for them, the game is the leverage game. Try to borrow as much money as possible and make enough return to pay back the borrowing with a slight amount of margin. Let's say a slightly increased spread so that they can make a profit. So different industries will play a different game. Or you take the old traditional companies, Tatas, Birlas. These people, they will also use their reputation to take more loans. And they will manage to make enough money from the loans to have a profit. But ultimately, for them, more important than margin or volume is the leverage. That is what you have to remember. So that's one thing. Then, if you understood this properly, can you just tell me, are you getting the point here? Tanya and Praveen ji?
Sir, once again, if you will explain, then it will be better to remind.
Okay. So I'm trying to explain again. Tanya, are you getting this?
Yes, sir.
You understand? So basically, what I'm saying is that, see, this return on equity that we have, how do we calculate return on equity? The simplest way to calculate return on equity is you take the profit after tax and you divide by shareholders' funds. On any balance sheet, you will see these two things. You will see that the equity is given, the reserves and surplus is given there. If you add these two, you will get your net worth. So this is the amount of money which the promoters and shareholders have contributed to the company. So this is the net worth of the company. It is very easy to take this figure. And equally easy is you take the profit after tax figure, you divide profit after tax by the net worth, and end up with a figure which you call the return on equity. Per 100 rupees of equity, how much return or how much profit are the investors making? This is very simple. But if you try to understand how do you get that return? How does a company manage to get a good return? Why do some companies get good returns? Why do some companies not get so good returns? So we sometimes think that the reason why a company gets a good return is the profit margin, which is very easy to understand. I take my profit after tax and I divide that by sales and I end up with the profit margin. I call that my net profit margin. So I sometimes, a layman will simply say that this particular company, it has an excellent margin. Therefore, it manages to make a lot of profit. But what this DuPont is explaining to you is that there are actually two more factors which are important. Apart from the margin, there is the volume of sales. How are we looking at volume of sales? We are trying to relate sales to the total assets. So if my total assets is 10 and my sales is 20, then I say that the turnover ratio is 2. That means my sales are 2 times my total assets. If I can get a turnover of 3, then that means that instead of 20, I am selling 30. And the more I sell, the more profit I make because there is a margin. So that is my second point. And the third point is that when I began the business, I had my equity. The net worth was there. The promoters had contributed their share, their particular capital. And apart from that, they had given shares to a large number of shareholders who had also contributed to the capital. Then over a period of time, they made some profit and the reserves came. So from that, they were able to buy assets. From this initial capital and the initial profits that they made, they were able to buy assets. And on the basis of those assets, they produced goods and they sold those goods. But you will understand that if I can increase the number of assets that I have, if I can increase the volume of assets, then it will be possible for me to have a higher level of sales. So let's say that my production capacity today is 1,000 units. Now I increase the number of factories that I have, and I now have a production capacity of 4,000 units. So now instead of selling 1,000 units of my product, I'm able to sell 4,000 units. So what happens is that the total assets has resulted in a higher volume of sales. And the higher volume of sales has resulted in more profit because per unit of sale, I am making a profit. I'm not doing a loss-making business. So that's point number 2. But when I created these factories, I borrowed money. Therefore, if I am able to successfully borrow money and use that money to create productive assets, I will be able to produce more and sell more. So the third factor is the amount of borrowing that I have managed to get. So if I have managed to get more borrowing, then I have managed to use my equity. Equity was always there, plus the borrowing to create more assets. And together we have managed to generate more sales, and the sales have resulted in a larger amount of profit. So basically, there are three factors which are coming into play. There is the margin. Every unit which I sell, if I can basically get more, it's a big good thing for me. There is the volume. The more I sell, the more units I produce and sell, the more I am able to get profit. And the third is the more borrowing that I can get. The more borrowing that I get, the more total assets I create. The more total assets I create, the greater productive capacity I have, the greater number of units I produce, and therefore I can increase my sales on the basis of this also. So to get larger volume, sometimes I need to borrow. So therefore, there are three things which are important: the margin, the volume, and the leverage. Now, different industries will play different games. For example, a company which is producing, let's say, luxury goods will focus on the margin because people are willing to pay extra for its products. Let's say there is somebody has an Apple phone. The Apple phone, for example, I use an Apple phone. This is my phone here. Now, this Apple phone costs much more than its counterparts in the market. But I paid more for it because I wanted to have the pleasure of having an Apple phone. So Apple gets a huge margin, and that is why it is one of the most successful companies on the world. What is the reason for it? It is margin. Now, volumes. A car company making cars for the masses will focus on selling more. They know that they cannot have a huge margin, because if they try to get a margin, you will have to increase the price. Now, if they increase the price, they will lose the market, because people who are buying these cars are people with lower income as compared with the person who was buying luxury cars. So this company is going to focus on reducing its costs and having a very sleek, a low price, small margin, but it will focus on increasing the sales. So as the sales increase, they will sell more units, even though the margin is less. Since the number of units is more, they will end up having a fairly decent profit. The other aspect is that if somebody wants to produce more, he requires more. If he relies only on the equity and reserves, only on the net worth, then he will not be able to generate sufficient funds to create a larger production base. So that person has to borrow. That type of firm has to borrow. And to borrow, they will basically have, as compared with their equity, the total assets will be much more. The difference is the amount that they borrowed, and that we refer to as the multiplier. So if their own contribution into the capital was 10 rupees and they are able to borrow 10 more rupees, then that means they have a multiplier of 2. That is the point which we are trying to explain here, that companies have to focus on this, the margin, the volume, or the leverage, and different industries do it differently. Praveenji, now do you understand this?
Yes, sir. Now it's clear.
Tanya? Tanya, have you understood? Okay. So this is one thought which I want you to keep in mind as we go ahead. And whenever you do the assignments, yes, Tanya.
सर एक्चुअली मेनी टाइम्स सर एक बार फिर से ज्वाइन करे सर, एक्चुअली बहुत ज्यादा वीडियो ब्रेक हो जा रहा है मतलब.
Okay, join again. Join again. Come.
Yes, sir.
The other thing which I would like all of you to actually focus on is how to do a ratio analysis and understand how good a company is, especially if we are comparing two companies. So first of all, it is always good to compare two companies in the same industry, because like we said, that different industries play different games. So like, for example, you have someone playing the margin game, someone playing the volume game, someone playing the leverage game. So if we focus on one type of industry, we will have players who face the same challenges, who sometimes come up with very similar solutions. So the strategies and everything are quite similar. So then we can actually see which one is doing better. So whenever you are faced with a lot of figures and you want to make sense out of those figures and understand how good a company is actually doing, what you should do is you should convert the figures into ratios. Convert the figures into ratios and then try to interpret the ratios. Try to understand how the ratios, what the ratios are telling. So if you look at the recording, Tanya is back. Okay, Tanya, you're back now. So
Yes, sir.
is it better? Is it better now?
Yes, sir.
So what I was saying is that, so DuPont, if you want to understand it more, go back to the video, listen to that. Listen to what the discussion that happened there. I think it will be very clear to you.
Yes,
Now,
sir.
the last part of the slides, which I showed you on financial accounting, these slides are also important because the assignment that you will get will be also from this area, this financial accounting area. And everything is very clearly explained in all the videos, in the presentations. You should be able to use these effectively to do the assignments. Now, what I'm saying, I repeat again, is that if you are faced with a large number of figures of two companies, you have the balance sheet figures, you have the profit and loss account, and now you want to make sense out of this. आप समझना चाहते हैं कि इसमें से इन दोनों में से कौन सी कंपनी बेहतर है, तो आप क्या करेंगे? What you should do is convert those figures into ratios. So we had discussed solvency ratios, we had discussed profitability ratios. So if you go back to that slide where we had divided all the, the different types of ratios and grouped them under two categories, profitability and solvency, you will see exactly what I'm talking about. And see here, we have these two companies, Marico and Colgate, and we are trying to do a comparison using the solvency ratios. So we start with the solvency ratios. This is the interpretation. This is what I was doing yesterday. Then we look at the operating cycle efficiency. See, the operating cycle efficiency, the main thing to remember here is operating cycle basically means from the day I invested in let's say the purchase of the raw material to which will then help me to produce my finished goods. So I have cash. The cash has gone to purchase raw material. The raw materials are converted into finished goods. The finished goods are sold, and then mostly it's sold on credit, and later on I collect these receivables and I get my cash back. So the time from cash to cash all the way back, that cycle, the longer this cycle is, the longer you will be out of cash. So the cash has gone, you are waiting for the cash to come back to you. The longer that cycle is, the more you will have to wait for the cash to come. So the longer the operating cycle is, the greater the problems you have related to liquidity and to paying your short-term creditors. That is the point which you should understand here. So if there is a company which has an operating cycle of 69 and another company, Mar'22, which has 128, you can immediately see that this company has an advantage because it is managing to get back its cash pretty early. That is the main thing that you should try to get from this. So all these ratios here, the purpose of getting all these, these period, conversion periods, payables period, the basic function of all these different calculations was to understand what is the length of the operating cycle. Once we understand the length of the operating cycle, we know that a company compared with similar companies, is it doing better? Is it doing worse? And what is the liquidity challenge for this company? So here in this, that is your main understanding. Then I have, of course, given this to explain the collection period and cash discounts, etc., for these two companies, Mar'22 and CPIL. Whatever is written here goes beyond the figures. So another takeaway from this entire session is that you need to read a little more about any company that you are analyzing. Read that you will understand the type of business, it's raw material, who does it's good to, how many does it have, how is it, what is there. You read about these, you will understand and interpret the figures better. And then the figures will become interesting. If you rely only on a dry interpretation of the figures, it will be a very monotonous and boring job. That is one. And it will not be complete. The basic thing is, for a complete analysis, it is necessary that you do a bit of reading. If you look, I have tried to just take one particular aspect, the inventory of Colgate and the inventory and payables of Mar'22. You will see how reading about the company has helped me to make this analysis. This is one. So that was the long-term solvency ratios. Then these are the ratios. Now we have the so this again helps you. You have the debt to equity ratio, the long-term debt to equity ratio, long-term debt to fixed assets, the times interest earn ratio. So this slide and this slide, go through these two slides, you will understand long-term solvency. There won't be any problem. So when you get your figures of some company, you will first what you will do is you will first and then second the gross profit, operating profit margin and the net profit. This again will do a worry about the company. Why a company doing well, all that is going to become very clear in a very simple way. Is the company, how profitable is the company? For example, I can see right away that Colgate has a fantastic margin of 15.7%. So for every 100 rupees of sales that Colgate has, it is actually managing to get a profit of 15 rupees 70 paise. If you take at Mar'22, for every 100 rupees of sales that it has, it is making a profit of 8 rupees. So basically, what is happening is that this margin thing tells you about one aspect of the company. What is profit margin? For every 100, how much does the company actually get? This Finally, this about the investment ratio. Invested in this company, how much they are getting. And so look at the comments which I have made here. You will see Tanya and Praveenji, were you able to get what I said about those ratios?
यस सर, बट वीडियो पॉज हो रहा था बार बार, वीडियो और ऑडियो तो हो ही नहीं रहा था clear. इसके लिए मैं एक बार आऊँ हुआ.
सर यही दिक्कत मेरे साथ भी आ रही है सर, वीडियो है ना पॉज हो जा रहा है, मतलब शायद हो सकता है सर आपके साइड नेटवर्क से सही नहीं है.
अभी ठीक है?
सर अभी तो आ रहा है ठीक से, लेकिन अचानक से कभी कभी बिल्कुल सर रुक जाता है.
Suddenly problem.
Then I think next week I'll have to pick a different place. Actually, I'm not in Pune. I'm outside. So, okay, let's just do one thing. Let me put it on my phone hotspot. That may be better. Okay. It's okay now, na? Right now it's okay. Raveenji, is it okay right now? Tanya?
Sir, still sir, again the video is paused and sir, voice is also not coming properly.
Then I think the other connection was better.
Sir, दोबारा रुक गया.
अब देखो, अब is it better now?
Yes sir.
Then I think this connection is better. I have an option between the Wi-Fi that is there in the building, and apart from that, I have my own hotspot. I think the Wi-Fi is working better than the hotspot. Okay, I think it's too late now to change the place, but see, broadly, see, let's forget about the video for a moment. Is the sound okay? Can you hear me properly?
Yes sir.
Okay, then what I'll do is I will just switch off this video and I'll just explain what I said again. Maybe you'll get less buffering. So what I was saying is that if if let's say I give you the balance sheets and profit and loss statements of two companies, and I tell you to analyze the two companies, which is better, or what are the strengths and weaknesses of these companies, then in that case, what you can do is you can conduct a ratio analysis based on the figures that you get in the balance sheet and profit and loss account. So what ratios are you going to look at? So you go back to the slides and you will find that we had made basically different types of analysis. So we had done short-term solvency and long-term solvency. We had done margin-based analysis in which we got the operating profit margin, the gross profit margin, the net profit margin. And then we had the return on investments, in which we try to find out what the return on assets is and what the return on equity is. So we had done all these, this analysis in the different slides. What you need to do is look at that again. Look at those slides again. Once you look at those slides, you try to basically make your own assignment in a similar way. Do it in Excel, you will not find it difficult. Once you get the data, then you try to understand what it means from what you have learned in the lectures which preceded this. At the end of the day, you will find out that you are in a position to actually understand the figures better. Since there will be, we'll have at least 1 week for you to do this job. So after your college or the office, you will have to sit down for a little while and work on it. If there are any problems, you call me. Call me, and so that I can explain. That is my main point. What I said right now, was this clear?
Yes, sir.
Tanya? Tanya, did you hear me?
Sir,
Yes, Tanya?
sir, can you hear me?
Yes.
Yes, sir.
So were you able to hear me?
Sir, not very properly, sir.
Okay, but you got the general idea, na?
Yes, sir. Sir, I will watch this video again. मतलब अभी पढ़ने के बाद एक बार फिर से हम देख लेंगे तो ज़्यादा अच्छे से clear हो जाएगा.
ठीक है, okay. So now I am going to start with the banking part. Arey, what has happened? Host has disabled participant sharing.
It is showing me as a host, sir.
But then you can't show the slide now, because can you just, is there some way you can make me the host? I am the host now. Okay, fine.
Then it's done, sir.
It's okay.
Okay.
So, now I will just, I'll show you this slide. But I don't think Can you see the slide?
Yes, sir.
You can, but I'm not getting the bar with your. I'm not getting the, your normally there is a panel showing the participants. Now, when I'm doing it now, I'm not getting that.
Once again, I think we should join the meeting. So it will
here. Now it's there. Can you see the video?
Yes, sir.
Okay, now then let's start with this. So, this unit on banking, what I will try to do is explain to you a little about how the banking industry works. So what does a bank do? And give you an idea about the size of the industry itself and some of the things which you read about in the news and which maybe you don't understand so well. So I'll just try to take you through that as we go ahead. So the first thing is look at the size of the industry. Look at the size here. The number of public sector banks is 12. So this we should just a minute. So I have written here figures as of September 2019. This is wrong. This is the figure as on today. These are the latest figures. I'll change this. Number of public sector banks, there are 12 today. So there has been a consolidation. Some of the banks have been merged with bigger banks. So there are today 12 public sector banks. There are 22 private sector banks, 11 small finance banks, 4 payment banks, 46 foreign banks. In the foreign banks, out of these 46, all are not active. There are only a small number of those banks which are active and which you see more in the metros of the country. You don't see them obviously in the smaller towns. And then look at the number of employees. There are over 7 lakh employees in the banking sector. And then you look at the amount of, the deposits that the banking industry has. So it has 154 lakh crores. So 1 lakh has 5 zeros, 1 crore has 7 zeros. So what we are saying here is 7 plus 5. So 154 lakh crores. This is one. The other thing is how much loans has the banking system given? It has given 110 lakh crores. And what is the ratio between the loans and the deposits? It is 71%. That means out of every 100 rupees that the bank has mobilized, it has given 71 rupees as loans. Where is the rest of the money? It has been invested in government securities, and some amount, of course, is retained by the bank itself in cash and bank accounts. So this is the first thing to understand here is the size of the industry, which this gives you. The second slide here gives you an idea about the different types of banks that we have. So at the top, there is the Reserve Bank of India. This is the central bank. It is the regulator of all banks. It gives licenses to the banks to function. It allows or disallows a bank to function. If the board is not doing well, it can actually sack the CEO of the bank. That happened with Yes Bank. If it either permits foreign banks to operate in the country or not, that's again up to them. So the total number of banks in the country, disregard this please, this 85, go by the earlier one, the slide that we had. So the commercial banks are divided into the scheduled banks and the non-scheduled banks. Now, normally when you think of a bank, it is the scheduled banks. The non-scheduled banks are banks which have a very small capital base. These are mostly cooperative banks. For the purpose of just knowing, you should know that there is something called a non-scheduled bank. But otherwise, when you think of a bank, think of it as a scheduled bank. Why is it called a scheduled bank? Because whenever a bank is given permission by a license by the RBI to do all the activities that we know that a bank does, it is listed in the second schedule of the RBI Act. And this actually lays down certain criteria which the bank has to follow. There are certain directions there which the bank has to follow. It has to maintain a certain amount of deposits in government securities, for example. It has to maintain a certain amount of cash with the RBI. There are other norms which it has to follow with regard to loans. So all those things are listed there in the schedule. That's one. Then how many banks do we have? Public sector banks 12, private sector banks 22, foreign banks 49. So this is the position of the sector today. Then you have the payment banks. In 2015, when Raghuram Rajan was the governor of the Reserve Bank of India, he said that why just have one type of bank? So why just have public sector banks and private sector banks and foreign banks? So they are basically catering to the same class of people. These banks are performing the same functions. So why not have some banks which are basically designed to cater to the lower income segments? So he said that let's have two new categories of banks. One he called a payment bank and one he called a small finance bank. Now, originally, almost 10 finance bank licenses were given, but today only 4 of the small finance banks are there. And there are 11 payment bank licenses which were given, all the 11 are there. Now, in the case of payment banks, the thing to remember is that they do not give loans. These are small banks. I don't know whether this is there in your city or not, but in Pune, of course, I see many of these banks. Paytm Payments Bank, Fino Payments Bank, Airtel Payments Bank. India Post has a payment bank since 2018. So these banks are basically just there to help you to keep your deposits. They give you good digital, let's say, service. All that is good. They do not give loans. So since they don't give loans, whatever deposits they get, these are invested in very safe securities, government bonds and things like that. As a result, these banks are safe. Since, see, the risk in a bank comes from giving loans which later on become non-performing and cannot be recovered. So when a bank is not giving loans, obviously to that extent it is safe. So that's one point. Small finance banks were created basically so that they could give small loans. So they will, of course, have deposits. They will work in the smaller centers. They will work with low, let's say, people who are less affluent, people who have less money, and let's say smaller enterprises who need loans. 50% of their loan portfolio has to be given for loans only up to 25 lakhs. So if they give a total of 100 rupees of loans, 50 rupees has to go for these smaller loans, which is capped at 25 lakhs. It cannot go beyond 25 lakhs. The other 50, yes, they can give bigger loans. Why is this being done? Because the idea is that if they can have a wider base of small loans, there will be greater diversification, and as a result, the bank will be safer. If one or two of those loans go bad, then at least the rest of the portfolio remains healthy. As against giving a very big amount to one person, and if that particular loan account goes bad, then the entire portfolio goes bad. So that was the idea behind this. So that is the basic classification of banks. These are the banks that are functioning in the country. Now, if you can hear me properly, let's see if you can respond to this. So what does a bank do? Tanya or Praveenji? What is the basic function? How does a bank function?
Accepting the deposit.
Okay, good.
Lending the money to, in the part
To
of
people. Okay,
loan
very
and
good.
other things, and keeping the reserves into RBI.
Very good. Very good, Praveenji.
And
Yes, Tanya?
In providing loans.
Providing loans, definitely. So you people have mentioned the two basic things. So Praveenji says that one is to take deposits, the other is to give loans. So essentially, these are the two main functions that a bank has. Now, when you look at the definition, what it says is it accepts deposits from the public for the purpose of lending. Now, it cannot take deposits and invest it in a share. It cannot take deposits and take that money and put it into real estate. It has to take the deposits only for the purpose of giving loans. That is in the definition of the banks. The other thing you should understand is that the bank is like the middleman between somebody who has excess money and wants to put the money in a bank to earn interest, and somebody who has a good idea in his mind and needs money. Somebody who needs a loan, so he can take that loan and whatever dream he has, whatever sort of industry he wants to set up, he takes the money from the loan, sets up that industry, sells goods, makes a profit, and then pays back the bank. So there are two groups of people basically. Some people who have, maybe they have a source of income from a job that they have or from agriculture. So these people need to put their money in a safe place. So these are the people who give deposits. So obviously there are thousands and thousands of such people. All these people put their money in the bank. That is the deposits that the bank gets. And then how does the bank make money out of this? It takes this money and gives it to people who can take this money and use it productively. So whoever takes the money from the bank should have an idea, some business model in his mind, so that he can take this money and use the money productively. That is the second part of it. Then, so the bank is basically an intermediary. What is the income that the bank gets? So the bank is, when it takes money from depositors, it has to pay interest to the depositors, obviously. And when it gives loans to a borrower, it gets interest. So it should get more interest than it pays. And whatever is the difference in between, from that, the bank has to maintain itself. All the costs related to actually running the bank, it gets from that. Whatever is left over, that is the profit that it makes. That is why the margin here is not very large. But as you can see, the entire game is borrowing. This entire deposits that they get, this is a form of borrowing. So for banks, it is more about leverage. So I'll show you in the balance sheet also. Then apart from this, the bank also has some other sources of income, which is not interest-based, but these are very small. For example, when a bank issues a bank guarantee, for example, like some people may come to the bank and say that we want a bank guarantee because the government is asking for a bank guarantee for, let's say, a tender. There is a road tender. Somebody wants to, give a quotation to the government that I'm willing to do this job, build this road for you. The government will say, first come with a bank guarantee, only then we will allow you to participate. So on the bank guarantees that the bank issues, they make a commission. Similarly, there is something called a letter of credit. So in the letter of credit, which is very similar to a bank guarantee, but it is meant for trade transactions, buy-sell transactions. In the case of letter of credit, once again, the bank gets a commission. So that is another source of income. Then smaller sources of income you can think of are, let's say, the lockers that we go to a bank and rent, or when we make remittances, RTGS, NEFT, this sort of thing. There again, the bank gets a small commission. So there are these other sources of income that a bank has, but as compared with the interest income, it is very small. Then the expenses again are also, the main expense will be the interest that it pays its depositors, but there are also non-interest expenses related to the costs of running the bank. The rent that it has to pay, the employee costs, and other operating expenses that the bank will have. So that's one. So you understand a bit about this non-interest income and expenses, what I've just explained. Just a word on the actual definition of banking. So this is from the Act. the acceptance for the purpose of lending, deposits of money from the public, repayable on demand or otherwise. The big thing to remember here is that it has to be repayable on demand. Anybody who puts money in the bank has the right to demand the money back. And even if it is, let's say, a fixed deposit, if he wants to demand the money back, the bank will have to cancel the fixed deposit and pay him back. So this part is critical. No other organization can accept a deposit that is repayable on demand. So there are non-banking financial intermediaries. They cannot take deposits that are repayable on demand. So you can't maintain saving accounts with them. You can't maintain current accounts with them. Only in a bank is that possible. So the other features that we saw is it is a process of intermediation. So the bank is a middleman sitting between people who have money and people who want. So that's one. Some individuals need to deposit money, other individuals need to borrow money. The bank is sitting in between. The bank is the intermediary. Then financial services are provided for a price. The aim is to lend funds obtained from depositors at a higher rate than the cost of funds and make a profit. So they should be able to lend the money, give loans at an interest rate which is higher than the interest rate which they are giving the depositors. As long as that spread is there between the interest paid and the interest earned, they will continue to make money. Now, what are the functions of banking? So they are the custodians of saving of the community. So all of us go to a bank and put our money there. And remember, when you put the money in a bank, you are putting the money on the basis of the reputation of the bank. You are putting it on trust. You are trusting the bank. See, normally in any financial transaction, both sides have something. Like if let's say that two people enter into a financial transaction to buy or sell, one person gives money, the other person gives goods. If you enter for a service let's say taking, let's say, a flat on rent, what will happen? Somebody gives you a flat, you give him money in return. So in all these transactions, both sides give something. But when you give money to a bank, what does it give you? It only gives you a passbook, or it gives you a little fixed deposit receipt, and it tells you that we will pay back the money to you whenever you demand. And you accept that. You are accepting it on trust. You have nothing. If the bank collapses tomorrow, your money will go. So we have seen where smaller banks have collapsed and where the depositors have lost almost all their money. Because they put their money in the bank on trust, but that is the basis of banking, trust. Then what the other function of banking is to give support for businesses and individuals. So that part is very clear. Then at another level, at the level of the country as a whole, it is through the banks that the RBI can increase or decrease the amount of money in the economy. So it is therefore a very crucial, let's say that there is inflation in the economy. So inflation normally is described as a situation where you have more money chasing less goods. Less goods, more money, therefore the price tends to go up. Now, if the, let's say, Reserve Bank of India, seeing that there is inflation, wants to reduce the money. So what it can do is, it will tell the bank, increase your interest rates. So when the interest rates begin to go up, people are attracted to the new interest rates. They deposit more money in the bank. As a result of that, the money supply in the economy is reduced. So similarly, if you, let's say, make credit cheap, more people will take loans. As more people take loans, what will happen? The money supply will increase. So depending on the need of the economy, the volume of money, the amounts of money in the economy can be increased or decreased. And that is done by the RBI through banks. So that is there. And then, of course, the bank provides a payment mechanism. So all of us, any payment that we have to make for any purchase, so the Google Pay that you use, or the Phone Pay that you use, or the money transfers that we do through NEFT or RTGS, or IMPS, all those things ultimately are provided to you, are made available to you because of the bank. So Google Pay will not operate if some bank is not there at its back. So it is only through the bank that any of the mobile wallets are able to function. So that's another thing that you should remember. The other thing, of course, is that there is an interdependence of the banks. You know, all banks need to be healthy. All banks need to function properly if the entire system is to be successful. Now, what are the major liabilities of the bank? First, biggest liability is deposits. So, why is deposits a liability? Because it is a source of fund for the bank. It has to be paid back. So, like we said, that all liabilities of the bank, all deposits of the bank are repayable on demand. Not all liabilities, but all deposits of the bank are repayable on demand. So this is the biggest source of funds for the bank. The second is borrowings. Now, the borrowings that the bank has are short-term borrowings. Why does it have to borrow? Because there may be times when the bank is short of money for a day or two. So maybe that, some depositor who had put in 1,000 crores, maybe the government had, some state government had deposited 1,000 crores in the bank. It wants the money in a hurry. The bank is able to arrange maybe 500 crores immediately. It needs more money. Where will it get that money? So it will borrow from another bank, which has a surplus. Or if not from one bank, it will borrow from many banks. So that, but then it will repay again in a day or two. That is the other liability. Then, of course, the initial capital which was put in the bank, of course, that is there. That liability is, it's the initial starting point for the bank. That is, of course, never paid back, but it's a liability. So when does a bank borrow and from where? That I've just tried to explain to you, that the bank will borrow mostly from other banks, or it can borrow from RBI directly. But remember that these borrowings, you should never think of these borrowings as the usual type of borrowing that we think 1 year, 2 years, 3 years, not like that. These are in days, 1 day, 2 days, 7 days, like that. Because within that period, the bank will again get that money back and it will be able to repay. And there will be a small amount of interest that it has to pay. Am I getting across? Is all this clear? Praveen ji, Tanya?
Hello, yes, sir.
All clear, na?
Hi, clear is.
Clear. Tanya? Okay. Now let's look at the asset side. Biggest assets of the bank will be the loans. So the money that the bank has taken from the depositors, this has to be given as loans to people. So when the bank gives a loan to someone, that borrower gives a financial commitment to return the money to the bank with interest. So that commitment which the borrower makes, you can think of that as the asset that the bank has. Apart from the actual physical assets which are there, for example, when the bank gave a loan to a person to, let's say, set up a factory, the factory is set up. The factory itself is an asset for the bank. But the basic asset here is the commitment of the borrower to return the money. The second aspect is the investments. So we'll understand this a little better as we go ahead. So these are compulsory investments which the bank has to make, and these are made in government securities. So government of India comes out with bonds, and the banks have to buy these bonds, maintain a certain level of SLR, statutory liquidity ratio. I'll explain this as we go ahead. But you should just understand that these investments in bonds are the second big asset that the bank has. After loans, the other big asset is investments. Why does a bank have to invest? Because it is mandatory. The RBI says that out of every 100 rupees that you take as deposits, 80 rupees has to be invested in a government security. Praveen ji, I think you'll have to mute yourself.
Sorry.
Okay. Can you just keep it on mute? It'll be good. Now, this is a actual balance sheet of 2017-18 of Axis Bank. So why I have done this is that you can now see for yourself the structure of this balance sheet. So look at the share capital. The share capital is only 513 crores. So this is the amount of money that Axis Bank has to set up the bank. Then, over a period of time, Axis Bank was able to earn profits. And over all the years of its existence, it has earned profits of 62,931 crores, which is here in this column, reserves and surplus. Now, what is the net worth or what is the total shareholders' funds? It is 63,445 crores. So this is one part of the liabilities. We said that deposits are the biggest chunk of the borrowings of the liabilities that the bank has. And you can see here, what were the deposits of Axis Bank as on 31st March 2018? It was 4,53,000 crores. And what were the borrowings that it had on that day? It was 1,48,000 crores. But this, of course, these are short term. This 148 is a short term thing. It will come and it will go. And then there are other liabilities and provisions which amount to 26,000. The biggest chunk here in the liability side are basically provisions made for non-performing assets. Loans which have gone bad, a certain amount of money is set aside by the bank. If the bank is unable to recover that money from the borrower, then at least it will be able to use this money to clean up the loan. Think of it like that. So what you can see is that out of this 6,91,000 crores that the bank has, the capital that it put up was only 513 crores. The balance, the entire balance of almost 6,90,800 crores is basically borrowing. That is why we say that the banking industry is focusing on the leverage game. When we were discussing DuPont and we discussed the equity multiplier and leverage, this is what I was trying to explain. If you look at the balance sheet of any other company, for example, we were looking at the balance sheet of Colgate, you will not see borrowings of this type. In fact, in the case of Colgate Palmolive, if you remember, the borrowings were very, very small. The interest was only 1 crore. So here, everything is borrowed. This is the thing to remember in the case of a bank. Look at the assets. 35,000 is basically in cash or with Reserve Bank of India. The biggest one is advances, which is 4,39,000. So the deposits are 453. So like when I asked you, what does a bank do? And Praveenji said that a bank basically takes money from depositors and gives loans to borrowers. So deposits and advances. So look at this. 4,53,000 was the deposits. 4,39,650 is the loans that the bank has given. So the two biggest items on the balance sheet are the deposits and the advances. So when we say advances, please understand this is loans. Please understand advances is just another word for loans. You should not get confused with this. The other aspect here, look at this, balances with bank, money at call and short notice. So this 7,900 crores is the amount of money the bank has given to other banks on a short-term basis. Some other bank approached it. Do you have some extra money today? I need 100 crores. The bank gave it 100 crores. That type of lending, which it has done, comes in this particular item. And this 35,000 balances with Reserve Bank of India, this is a mandatory thing. The bank has to maintain a credit reserve, a cash reserve ratio of 4%. So this is what the structure of the balance sheet is. The other aspect is that the second biggest item on the assets are the investments. So these 1,53,876 crores, basically this is being invested in government bonds as part of the requirement of banks to have 18% as SLR, statutory liquidity ratio. Now look at the profit and loss account. What is the major source of income? Interest. So interest, discount on advances, bills, think of this as interest on loans. This is the main source of income here. 34,000 crores they have got as interest. And out of this 34,000 crores, they have given 27,000 crores as interest to the depositors who have given it money. So we had 4,54,000 crores of deposits. So for those depositors, the bank has paid 27,162 crores as interest. But fortunately, it has earned more. It has managed to get 34,000 as income from there. The other second largest source of income is coming from investments. So the bank, like I said, had made lots of investments in government bonds. And these investments that it made, obviously that is paying them an interest. So that interest is reflected here, income from investments. Then the borrowings, the lending that the bank has done, it has lent money to other banks. From that, it has managed to earn 387 crores. Then some other income is here. This income is also basically some form of interest income. And then the total interest income therefore comes to 45,780 crores. This is the main income source for the bank. Other income, like we were saying, that there are other sources of non-interest income like commissions on bank guarantees or commissions on letters of credit. That is reflected here. If you pay rent to a bank for a locker it has given you, that particular income will come here. So that's one. So the total income, as you can see, is 56,747 crores. Now, if you look at the expenditure, 27,000 went for interest to the depositors. This part here, 4,000 was paid, 4,312 was paid as salaries to the employees. Depreciation on the assets is 568 crores. The main depreciation item here is the computers that the bank has. So all the, the servers that the bank has, these have a very high rate of depreciation. Since computers tend to become obsolete pretty fast and have to be replaced or upgraded, therefore they have a 33.3% depreciation rate. That is why this figure is so high, 568 crores. And then the other operating expenses, other than the salaries that the bank has paid to its employees, that is coming to 9,000 crores. So these are the main expenses. This part here is basically the provisions that the bank has made. For taxes, this part is taxes. This is the provisions for non-performing assets. So loans which have gone bad, the bank is expected to keep a certain amount of money aside for that particular eventuality where the loan is not recovered from the borrower. So as you can see, this is a huge amount, 15,472 crores. And this is the basic structure of the bank balance sheet. So when you compare this with the balance sheet or profit and loss account of a manufacturing company, as we were doing in the financial accounting classes, that it will give you a very good idea of how this particular, these financial statements are different. So that's one. Now, the next section that I come to is the reserve requirements of banks. So, as per the RBI's, so I'll just show you this slide first. February 10th, 2022, the RBI came out with certain, the rates of CRR, SLR, the repo rate, reverse repo rate, all these things. Every 2 months, the RBI comes out with new rates. This is the rate which you have to give. So the cash reserve ratio is 4%. What does this 4% mean? It basically means that if the bank has taken 100 rupees as deposits, out of that, 4 rupees should be deposited in cash with RBI. So this amount is kept like a reserve with RBI. And you can think of it as a safety cushion. 4% of the deposits the total deposits that the bank has. So for example, we noticed that the total deposits of Axis Bank in that balance sheet was 4,39,000 crores. So 4% of 4,39,000 crores has to be kept as a cash reserve with the RBI. Now, this 4% can be reduced or increased depending on what the RBI says. It has been 4% for the last 2-3 years. The other aspect is the statutory liquidity ratio. So out of the 100 rupees that the bank has, 18 rupees should be given as, please ignore this 1825. I'll correct this before I send it to you. This was the earlier rate. In 2020, this was the rate which was there. It has now been brought down to 18%. So 18 rupees has to be kept in government bonds and treasury bills issued by the government of India. So these, if you remember from our initial lectures, these instruments have zero risk. They are issued by the government of India and they will be paid on maturity. There is no risk as such on that. So going back to our earlier slides, back to this slide. So statutory liquidity ratio, bank has to maintain. This is known as a statutory reserve requirement. It has to keep this money. It will earn some interest. So the government bond has a certain interest. Every time the government comes out with the issue of bonds, it announces a certain rate of interest which the bond has. So it could be 6%, 7%, 8%, depending on what the liquidity conditions are at that point of time. So it will earn interest, it has the least risk. Now, the cash kept with the RBI does not have any interest. So that 4% which the bank keeps with the RBI is basically a loss for the bank. But since it is a requirement, it has no choice. It has to keep that money. If it keeps excess cash with RBI, sometimes that happens, then the loss only increases. So long back there, the RBI used to pay a little amount of interest on the reserves which the bank kept with it. But for a very long period of time now, the RBI does not actually pay any interest on that. Okay, so these are, figures which will vary from bank to bank. The the amount of loans that they have, government securities that they have, these will not be there. But think of it like this: 1,800 rupees the bank gets as deposits. 18 rupees it has to keep in a government security, a government bond or a treasury bill. 4 rupees it has to keep in cash. So that means 22 rupees is gone. What is left is 78 rupees. So out of this 78, it has to give loans. And if you recall the first slide, the credit deposit ratio was 71%. So you may be thinking that if the bank is getting 100 rupees, why are they giving only 71 rupees of loans? So now you understand that the 100 rupees that the bank got, 22 rupees went to meet the reserve requirements. 4 was kept to the RBI, 18% was kept in the form of government securities. So the amount of money left with the bank was only 78. And out of that, system as a whole, they have given 71. So that is what you should try to remember. Here I have tried to explain to you a little about the different instruments in which the bank invests. So the treasury bills are normally issued for a period of 91 days, 182 days, or 364 days. So these are short-term instruments. The bank can invest in this. After 91 days, if it matures, they will get the money back. It can also sort of buy government securities. It can buy cash management bills issued by the government of India. The big thing about all these instruments is that on any day, they can be sold to some other party. Any other bank will be willing to buy. Some banks will always be short of securities. They will be willing to buy some securities from a bank which has extra. Because remember, these government bills are not issued by the government every day. So if you require a government bond, you have to buy from the existing stock. Whatever government bonds have been issued by the government in the past, that has been bought by various bankers. If one bank today wants to invest in a government bond, it will basically buy a government bond from a bank which has the bond already and which has a surplus stock. So that, transfer of bonds from one bank to another, interbank trading of bonds, that is very, very common. And that is what gives liquidity to the banking system. So if a bank wants money, it can sell a bond. A bank has extra money, it can buy a bond. So this is the relevance of this particular slide, the type of securities that the bank has. So you can just have a look at it and you'll get an idea about how these securities actually function. Coming back to this slide, there are two words here, one word rather, repo. So the repo rate is 4%. What is the repo rate? This is the rate at which RBI lends to banks. So if the bank wants to reduce the money supply, it increases the repo rate. So let's try to understand this quickly. Why is it called repo? Repo is a short form for repurchase. Repurchase. So the way it works is like this. Let's say that a bank wants to take money from the RBI. Let's say the amount is 100 crores. RBI will say, you give me as security 100 crores of treasury bills that you have, or 100 crores of government bonds that you have. So what they will do is, the bank will give the RBI 100 crores of bonds. This is happening digitally. And the RBI will give the bank 100 crores of cash. Let's say this has been taken for 7 days. For 7 days later, what the bank will do is, it will repurchase the bonds which it had given to RBI from the RBI. So basically, how will it repurchase? It will pay RBI 100 crores plus the 4% interest. So once it has paid that the interest and the principal amount, RBI will return the bonds to the bank. So basically, this is what the repurchase has been. In the first leg of the transaction, you can say that the bank sold its bonds to the RBI, received money. In the second leg of the transaction, when the bank had to return the money, it repaid the RBI or bought back the bonds by paying the amount 100 crores plus the rate of interest for a period of 7 days. This is the concept of a repo rate. Now, the same thing is called a reverse repo when the RBI wants to borrow money from the banks. Why would the RBI want to borrow money from a bank? Because if the RBI wants to reduce the money supply in the economy, it will tell the banks to basically give it money, in return for which they will give the banks a bond, basically. The RBI will receive bonds, the bank will transfer money to the RBI. So that is the basic concept of repo and reverse repo. Did you understand that, Praveenji?
Yes, sir, it is clear.
Yeah, fine. So you can read about it in the slide also. I've tried to explain all this here in the write-up. But this will give you a broad idea of what is happening over here. Now, the next part, which you may like to understand, is that banks have to be regulated. So, regulated means the functioning of banks, what a bank is doing, how much money it has, whether it is giving loans of good quality or not, how the bank is actually being run. This entire thing has to be monitored very closely because the bank has such a large amount of money. So we just saw in the beginning that the banking system as a whole has as much as 154 lakh crores of money which belongs to the public. So if institutions have such a large amount of money, it becomes necessary for someone to regulate it, someone to oversee how that money is being used by the bank. Is it actually giving loans of good quality to ensure that the bank is not taking too much of a risk, is in compliance with all the other guidelines of the RBI? So because of that, you have a regulator. That is what I have explained over here. Banks are custodians of savings of the people. So their financial health directly affects the lives of millions. If a bank collapses, all those thousands and thousands of people who had deposited their life savings in the bank are suddenly left with no money. And in fact, over the years, from time to time, we have seen banks which have collapsed. So this has often happened with cooperative banks, which have collapsed, and all the depositors of the bank are suddenly left with no money at all. So just imagine how badly off those depositors are because the bank actually collapsed. So to make sure that the collapse doesn't happen, there has to be someone who is there to supervise, or rather to oversee the functioning of the bank. So how does the RBI actually regulate banks? The first step, of course, is the banking license. So when the bank issues, when the RBI issues that banking license, it issues it only to people who have the capability of running a bank. People who are willing to put up the amount of capital that is required, who have the experience and the capability to actually run the bank. That is the first requirement there. You might find it interesting to know that up till 1991, right from the time of independence up till 1990, not even 1991, 1994, the RBI was not issuing any fresh license for a bank. So apart from the public sector banks which were there and the existing old private banks, so those were called old private banks, these banks were in existence from before independence. Apart from those banks and the public sector banks which were there, RBI did not give any licenses to any new player. After liberalization in 1991, RBI issued licenses for the first time to private sector banks, and that is when HDFC, ICICI, Axis Bank, etc. came into being in 1994 and onwards. So the first step was to see that these new players who are coming in and who will be asking people to give them deposits and to make sure that these are good players, RBI vets the proposals very, very closely. And as you can see, they do a fairly good job. HDFC is doing so well. It is not just a prominent bank in India, but even at a world level, in terms of financial health, it is really doing a great job. ICICI, Axis Bank, all are reasonably good banks. These are the banks which RBI has given licenses to. So that is the first step. Find someone who is really good, only give those people the branch license. Then the appointment of directors, make sure that the directors which are there are good, are competent people. Then the second part is that the capital requirements of 9%, this I will explain when we get to this part, what this 9% exactly means. For the moment, just let's leave this part because I don't think it can be explained at this point. So the governance of the bank, how the bank is actually governed, that again is looked at by the RBI through the appointment of directors, advances, mandatory lending to the priority sector, exposure norms. There are rules in place to ensure that banks do not overexpose themselves to one particular sector or to one particular borrower. An attempt is made to ensure that the portfolio, the loan portfolio of the bank is reasonably diversified. That is one part. Then the CRR and SLR, of course, what we just discussed, that controls the liquidity and credit creation of the banks. It provides a safety cushion also, and at the same time, it regulates the amount of loans that the bank can actually give. So we just saw that 22 rupees out of every 100 is actually being used for the reserve requirements. Only the balance of 78 can be given as loans. So when we say credit creation, this is actually a reference to the loans which the bank gives. Then apart from that, the bank has this surveillance system where it inspects and audits the banks on a quarterly basis. And there is an annual audit also. So the RBI has an office actually at the head office of each bank where its inspectors can go and have a look at the quality of lending that the bank has done, study the different items on the balance sheet, and see whether the bank is actually following the rules and guidelines of the RBI in totality. If it is not, it will have to explain. Otherwise, there can be very severe penalties, including things like sacking the CEO or restrictions on the loans, etc., that the bank can make. Then, of course, there are the KYC norms. So you might recall that if you want to open an account with the bank insists that you show your Aadhaar card, you give it proof of identity, and you give it proof of address. What is the bank actually trying to ensure? The bank is trying to ensure that the person opening the account is a genuine person. He's not a benami fellow. Just a name which is being used by someone who wants to stay behind the scenes. So that is another aspect, this KYC norms. This is also a way of controlling the type of let's say, depositors that a bank can have. So a bank cannot take, have benami accounts which are actually fronts for criminal activities. So this anti-money laundering guideline is also basically there to ensure that the proceeds of crime, etc., are not diverted through the banking system. So this is part of the regulation. Then under Section 6 of the RBI Act, there is this, there is a very detailed guidelines about what work the bank can do. So it should take deposits, it can lend to borrowers, it can invest, it can provide remittance, collection, and other trade-related services. It can provide ancillary services, for example, the locker that we mentioned, or let's say the letters of credit and bank guarantees which the bank gives. It can also have other activities allowed by the government, such as the sale of third-party products like mutual funds, insurance, gold coins. Why is it called third party? Because these products are not made by the bank. These are not offered by the bank on its own. It is offering somebody else's product. So if it is offering insurance, for example, or a mutual fund, the company which is actually making this insurance available is a separate company. Only the product is being sold through the bank. Now, the next part here, which we'll get to, is we look at this slide at the end, if we have time, the concept of asset liability mismatch. We'll see this later. Let us come to this, I think, which is much more relevant. How much capital does a bank need? Now, as per the regulatory requirement, you require 200 crores of capital. But in practice, what happens is that if you want to increase your loans, you will have to increase your capital also. Because there is a relationship between the capital and the loans. So when we say that the capital required by the bank has to be minimum 9%, it means that if the bank has given 100 rupees of loans, it should have 9 rupees as capital. Think of it like this. If a bank has only 9 rupees as capital, it cannot give more than 100 rupees as loans. Because if it gives more than 100 rupees of loans, then this ratio will go below 9. So basically, if the bank wants to give more than 100 rupees of loans, it will have to increase the capital from 9 to 10 or 11 or something like that. So one purpose here is to make sure that at least this minimum 9% of capital is always available with the bank. Because remember, everything else that the bank has is a borrowing. The deposits are borrowed. It borrows from other banks also. So everything that it has is borrowed. Therefore, there is an insistence that if you are increasing the amount of loans that you are giving, you should also increase the capital that you have. Because remember, every loan that the bank gives, there is a risk involved. And the risk is severe enough to result in the loss of the entire amount of loan that is given. So if the borrower goes bankrupt, the entire amount itself is gone. So there is a committee of central bankers. The Central Bank of India is RBI. The Central Bank of, let's say, Singapore is MAS. The Central Bank of the US is Federal Reserve. So all these central bankers, they get together in a place called Basel in Switzerland. And they sit down and discuss the banking situation for the world as a whole. And Basel comes out with certain, that committee of bankers, they come out with certain guidelines about how much capital a bank should have, and how the bank should actually calculate the capital, what are the risks that the bank can take. So according to Basel, the minimum amount of capital that a bank should have is 8%. RBI, to be on the safe side, says that banks in India should maintain a capital adequacy ratio of 9%. So that is one. What does this mean? We will understand this in the next few slides through the concept of what is known as a risk weight. And that I'll try to explain to you in this slide here. Let's look at this particular slide. You will understand the concept of risk weight. So look at this first, this bigger box here. Look at this. Let's say that in the first column, I have different types of loans that the bank has given. Just for the sake of convenience, let us imagine that in each category, the bank has given, let's say, 1,000 rupees of loans. So it has given 1,000 rupees to the central government. Let's say that this could be, let's say, a loan to an enterprise, a public sector undertaking guaranteed by the central government. It has given 1,000 to a state government. It has given 1,000 to micro enterprises, small businesses, which are under a guarantee scheme of the government. The government is saying that give these people loans. In case they do not pay, we will pay. So this is under a guarantee of the government. It has given loans to exporters guaranteed by the Export Credit Guarantee Corporation. So ECGC has guaranteed it. It has given loans to companies which are not rated. For the moment, just think of it like this. It has given loans to different companies. So different companies in different sectors, Colgate, Palmolive, Marico, just about any company, JSW Steel, it has given loans to them. And it has also issued credit cards, and the customers have, let's say, as on the date we are compiling this, the customers have used their credit cards up to an amount of 1,000. They have actually made payments using the credit cards. The amount which they have used is 1,000. So basically, the bank, let's say, has 6,000 total of loans. Now, if I say that the capital adequacy is 9%, then that means that out of 6,000, you'll think that the bank should maintain a capital of 9%, which is 540. 9% of 6,000 equals to 540. But the calculation is not that simple. What complicates this calculation is the concept of a risk weight. So basically, the risk weight tells you how risky is this loan. This loan to the central government of 1,000 is considered to have no risk. So the bank does not have to keep any capital on this. So the value of the loan for the purpose of calculating capital is 0. Now, if it has given 1,000 to the state government, the risk weight is considered to be 20%, 0.20. So the risk weighted value of the loan is 200. So when we reach here, you will understand this concept of risk weighted value better. Just stay with me and let me use those words. You'll understand it in a while. It has given loans to all these small businesses of 1,000. Since they are guaranteed by the government, for the purpose of capital, the risk weight is again 0. So risk weighted value 0. It has given loans to exporters who are covered by the ECGC. The risk weight is considered to be 50%. So out of 1,000, 50% is guaranteed, 50% they have to keep as the risk-weighted value of the loan. Loans to corporates with no rating. They have given loans to companies. These are not very top companies which have excellent credit ratings. So here, the 1,000 will have a risk weight of 100%, which is therefore 1,000.
Sir,
Yes, Praveen.
there is a doubt, sir. Export loans under ECGC, that is also government.
It is government, but I think because it is export and it is exposed to risks beyond the government, it's an international thing. Therefore,
Okay, like today's time, that is Russia and Ukraine. So if these things happens.
yes, just like that.
Okay.
So if somebody had given, let's say, a loan to exporter in India exporting goods to Ukraine, and there is a war in Ukraine, and let's say the company which he gave which the exporter sold the goods to, because of the war, that company is now no longer able to function. It is unable to repay the exporter the money for the goods which it has sold to that company. In that particular case, what will happen is the ECGC will repay the bank. That guarantee is there. But for the purpose of calculating the amount of capital required, the risk weight is considered to be 50%. The amount of guarantee which ECGC is giving, to the bank for giving the loan to the exporter may be a different percentage. It could be 70%, 80%, it could be anything. But for the purpose of calculating how much capital is required for the bank, you will give 1,000, but you will consider it to be only 500. Get it? You get the point, Praveen?
Yes, sir. Yes.
Now, credit cards is considered to be very risky. Therefore, for the risk weight is more than the amount of loan, so it is 1.25. So for the purpose of calculation, this 1,000 will become 1 multiplied by 125%, which is 1,250. This will be the amount which the bank will have to consider for maintaining capital. Now, how much capital does this bank need? You add all this up, you will get 2,950. You get 9% of 2,950, and that is the amount of capital that the bank actually needs. What is 9% of 2,950? It is 265.50. So now if I had taken 9% of 6,000, I would have taken straight away 540. But now what I'm doing is I'm saying that this 6,000 in terms of risk is equal to 2,950, because capital is maintained for the purpose of having a cushion against risk, for the purpose of mitigating risk. But since some components of this loan portfolio does not have risk. Since it doesn't have risk, therefore, the amount of capital that the bank is expected to maintain is less. And so I will calculate it. I will first get the risk-weighted value. Now you can understand the concept of risk-weighted value. And I will then add it up. This I will multiply by 9%. And that is the amount of capital that I'm expected to maintain. So this is the basic rule for calculating capital, and this is the concept of risk weight. After this, you can basically, like what I want you to do is have a look at the balance sheet of any company. So all of you in the index-based and common-sized analysis that you had done, you had downloaded the balance sheets of different companies from whichever site you chose. I think it was Money Control. So some of you had taken pharma companies, some of you had taken chemical companies. I think Praveen ji had taken pharma companies. So Praveen ji, for example, you take those pharma companies' balance sheet and you compare it with the balance sheet of Axis Bank, which is there in this presentation. And you will see that there is a distinct difference in terms of leverage. As far as leverage is concerned, you will find that no matter how much debt Ajanta Pharmaceuticals and that other company that you have taken, they have taken, Glenmark, whatever they have taken, it will be nothing like the borrowings which are there in a bank's balance sheet. So that is another learning for you. That in a bank's balance sheet, the main part is the borrowing part. So do this, you will get a good idea about the leverage that a bank has.
Tomorrow I will try to do that also.
You just have to compare it. You can take any of these and you can do this.
Okay,
so with that, I think we can stop here today. In the banking section, if I think there is anything more that I can explain to you, there was one more concept which requires a little more time. Maybe next week I will try to do that. That will complete our course. And then I will try to revise what we did from the beginning. All the major things that we did in each of the units, which were a little more complex, which maybe you'll understand them or recall them better when I revise. We'll do that in the next 2 classes that we have. That means on today is the 13th. So the ones we have on 19th and 20th, Saturday, Sunday, then we will revise the entire course, and that will prepare you for the assignments that I will be giving you after that. That is the plan. So next week and the week after that, please make sure that you are there in class.
yes, sir.
Okay, so all of you. And if at all you are in touch with Shruti and Alice and Paresh ji, please give them this message that they should attend the next 2 weeks.
Tell Shruti, I'll tell her, sir. So to Shruti, I'll tell her.
Tell Shruti. I will tell Paresh ji myself, and Alice, I'll tell her also. I'll also put a notice on the group to make sure that you attend those 4 classes, because next week is important because of the revision, and the week after that is important because that is when we will actually be having the actual tests. So that's it for today.
Yes, sir. Okay, sir.
Okay then. Good night.